This is a trading chart showing a classic support breakout trap. You buy at the bounce, place your stop loss right below the trend line, and watch as the price dips, hits your stop, and immediately shoots straight up without you. When we zoom out on this exact same chart, that painful trap looks very different. Large institutions require institutional scale orders to enter the market. To fill those positions, they have to force retail traders to sell. Hitting your stop loss provides the exact liquidity they need to fuel their rally. Tracking these large players starts with the foundation of smart money concepts, market structure. This chart illustrates a clear positive trend. The price forms consecutive higher highs and higher lows. We identify the most recent swing high and extend a horizontal line straight across the chart. When a new candle closes cleanly above that line, it creates a break of structure. The institutions are signaling that the upward momentum is intact. Instead of buying the breakout and risking a trap, you wait for the price to pull back into a demand zone before entering. Reading a break of structure is the first step to trading alongside institutional momentum, rather than getting caught on the wrong side of the market. To validate a break of structure, you have to look closely at how the candles close. This chart shows a price level testing resistance, leaving behind long wicks but failing to hold. A strict, reliable break of structure only occurs when a full candle body closes entirely above the highest tip of those previous wicks. A line chart only tracks body closes, which can trigger a breakout signal much earlier. Warning tone. Relying on that looser method leaves you exposed to false breakouts. Waiting for a full body close above the wicks is the safer approach. Eventually, every upward trend stalls. To spot the exact moment the market turns, we look for the most recent swing low, the specific dip that launched the highest peak on the chart. If the price drops and closes a solid body below that critical low, it triggers a change of character. The buyers have exhausted their momentum. A break of structure keeps you safely in a trend, but a change of character signals the precise moment the trend reverses, giving you the chance to exit or short before the rest of the market reacts. This chart displays a textbook rising trend line. Every time the price bounces, retail traders buy in and place their stop losses directly underneath. In smart money concepts, these clusters of stop losses are called liquidity. Institutions actively hunt these areas. A sudden price drop pierces the trend line and triggers all those stop losses at once, absorbing the shares required to fill high-volume buy orders. The specific candle responsible for that liquidity sweep is called an order block. After capturing the retail stop losses, the price forcefully pushes upward from this block and breaks the market structure. A valid order block marks the exact footprint on the chart where large players absorbed retail liquidity to fund their expansion. Once an order block is formed, we filter our entries to secure a tight stop loss and a large profit target. This scan box is drawn from a recent swing low to the swing high. It divides the price action into a red premium zone at the top and a green discount zone at the bottom. Institutional algorithms avoid buying in the premium zone. They wait for the price to drop deep into the discount zone, where they can accumulate shares at wholesale prices. Your point of interest sits squarely in this green area. Locating an order block inside the discount zone allows you to enter at the same wholesale prices where institutional buying is most concentrated. Look at these two charts. Chart A shows a standard demand zone with untouched equal lows resting just below it. Chart B shows a demand zone where a single wick dips down, clears the lows, and breaks structure. It is the valid order block, hunting stop losses for fuel, whereas Chart A left the liquidity intact, turning it into a trap. To execute a complete master trade, start by mapping the macro trend. This chart shows a confirmed break of structure at the top. We draw the GAN box and wait for a deep pullback into the green discount area. Inside that area, we locate our point of interest, an order block that has already swept local liquidity. As price touches the block, a lower timeframe change of character confirms the buyers have taken control, setting up the entry for a sustained rally. Break of structure for trend, change of character for reversals, liquidity for fuel, order blocks for entry, and the GAN box for pricing. Combining these 5 elements allows you to stop trading like retail prey and start tracking the moves of smart money.